For several years now, interest rates have been the driving force behind price movements across almost every ownership category, from stocks and bonds to real estate and even cars. But interest rates don't move on their own. They're shaped by a complex mix of factors like exchange rates, government deficits, tax policies, oil price, and global political events. On top of that, government intervention and automated trading systems can ripple across entire markets, sometimes making even well diversified portfolios vulnerable. And when short term tactics like hedging replace long term strategy, it can magnify those shocks rather than reduce them. I'm now joined by Brendan Caldwell, director at Caldwell Securities Limited, to discuss this further. Brendan, thank you for the time today.
Well, thank you, Theresa. Yes, interest rates have a big impact on, well, the price of everything. But what do you want to ask?
Well, Brendan, we just outlined how interest rates have influenced everything from home prices to car loans. But what are the biggest forces actually driving those rates right now? What is the determining factor?
Well, I think interest rates themselves are the determining factor because they're really the price of money. How much it costs to borrow money, short term, long term, is what interest rates really are. And for years and years and years, decades, in fact, money was very cheap, down in the very low single digits. So now that interest rates are up at 3, 4, 5%, maybe even higher on certain loans, it seems egregious relative to what they were. But even by historical standards, rates are very low, at least in absolute terms. The question is, what are real rates doing? What is the interest rate compared to the rate of inflation, the rate at which prices on goods and services are going up? And there's been a lot of factors on that. The biggest of which, as the chairman of the U.S. Federal Reserve said recently, has been this whole discussion you had a minute or so ago about tariffs. There's been so much talk about tariffs all over the world, being originated with the Trump government of the United States. Canada was the first and primary target. And I think my advice at the time was to just wait it out, because clearly we were not the real target of whatever Mr. Trump's ire has been. You'd said in your opening segment about the BRICS countries, Brazil, Russia, India, China, and South Africa, or whatever other countries you want to toss in there. These countries that are either have a tense relationship with the United States or not exactly a cozy one, but also are big economies in their own right, are looking to figure out a way to trade without the U.S. dollar being the intermediary. And I think Mr. Trump's trying to have his cake and eat it too, to impose tariffs globally and yet at the same time keep the U.S. dollar as the reserve currency for the world. Because it's been that reserve currency, because it's had that status, it has been one of the features of the United States. They've been able to borrow at very cheap rates. I mean, considering the deficit and the size of the U.S. debt, the fact that interest rates are so low in the U.S. is really a factor, is really made possible by the fact that countries all over the world take in U.S. dollars and use that as their reserve currency. So in fact, the U.S. can print money almost willy-nilly and still keep interest rates low. How long this continues remains to be seen.
And are countries still buying the US dollar as they were, in the past?
I think there's a real push to try and not to. There's been probably reduced demand because I think fewer people are going to the U.S. So if you look at Canadian tourist numbers to the U.S., they're down quite a bit. I know my own family's been reluctant to travel across the border for reasons. I have comments about how many Canadians they have in custody in the U.S. because of going over some immigration glitch or other. So yeah, I think people are buying fewer U.S. dollars, but then the number is still big. It is still the world's reserve currency. It is still the currency in which commodities like gold or oil are priced. So for the foreseeable future, unless Trump somehow manages to break the system, I think that the U.S. dollar is still going to be in high demand all over the world.
And is gold still the go-to during turbulent markets?
Well, gold. One thing Canada at least has the ability to is produce more of that, and would that with Mr. Carney's bill that will allow for hopefully mining and other resource exploration projects to be fast tracked. Hopefully, we'll continue to produce more of that in this country. Yes, gold is the flip side of the US dollar. And with all this global uncertainty, one had seen the cryptocurrencies, you've seen Bitcoin go from hundreds of dollars to tens of thousands to now north of $100,000 a coin. Ethereum, the Canadian equivalent or the Canadian answer to Bitcoin, has also done well, though not bounced back nearly as much. And gold had lagged, I think, really because the cryptocurrencies had been doing so much better and had attracted a lot of that money that was looking for an alternative to U.S. government fiat, printed by the will of the government, fiat currency. So
Now,
gold now is catching up.
well, I want to go back to the stock market. It's said that there's no place for emotions in the stock market. Could you tell us about that?
It is very difficult to invest if emotions are your primary driving factor.
Mhm.
A stock doesn't care if you own it. You may really love a particular stock or a particular market or a particular strategy, but that strategy, market, or stock is completely indifferent to you. If it's a romance, it's a very one-sided romance. So the best way to buy a stock is to have the idea why you want to buy that. And if the reasons that you're wanting to own that stock, to own that investment, are still consistent, great, continue to own it. But if the reasons change, then I think it is good to take a clinical, non-emotional look at whether what you're doing is still consistent with the reasons that you're